to, thank you, Audrey. Where the San Diego chapter and Cooley invite you to discuss special issues and considerations relating to executive compensation and employee benefits that arise in the context of mergers, acquisitions, and similar transformative corporate events. Topics we'll cover today will include 2024 market trends, share reserve utilization strategies, managing varied stakeholder interests, Section 280G parachute payments, and navigating compensation disclosure scenarios. And today from Cooley, we have Ajay and Rama, and I will let them introduce themselves and take it away. Thanks everyone for joining.
Great. Thank you so much, Diana. And before we dive into the substantive content, let me make sure I can screen share properly and I share the right screen. And I don't think I have anything embarrassing up, but just to make sure. So should be going there. So Rama will introduce herself in a second, but my name's Ajay Athavale. I'm a senior associate in the compensation and benefits group at Cooley. I advise employers on kind of day-to-day issues with executive and equity compensation and all sorts of compensation and benefits related issues. Also, in the transaction, in addition to the day-to-day context, whether it be IPO or M&A. I am, give you a little fun fact to lighten the mood a little bit. I'm, not from San Diego. I'm actually from San Francisco, but I went to UCSD and I have an 858 cell phone number. So I think that makes me an honorary San Diegan. I don't know how fun of a fact that is, but I will give you a fun opinion as well, in that I think that, especially here in San Francisco, we feel like the day after the Super Bowl should be President's Day and not next week, because we needed that day yesterday. So that's my opinion, is President's Day should be moved the day after the Super Bowl. So I will let Rama introduce herself now.
Hi everyone. I'm Rama. I'm an M&A partner, and I am here in San Diego. And I have a very broad-based M&A practice, representing private and public companies. And it's been incredible being in San Diego to see how the M&A market here has matured during my time in San Diego. So excited to be here with Ajay. And so I guess now I have to tell you something about myself, because Ajay did. And I guess I just woke up today realizing, so I have a ninth grader who I guess is eligible for a driving permit in a couple months, and which I find fairly amusing, because as a traditional Southern Californian, I personally cannot parallel park myself. So it seems odd that my child should be allowed to have a driver's permit when the parent doesn't know how to parallel park. So there you have it. You know something about me. So be careful, I guess, when I'm on the road, just like the other San Diego drivers.
Awesome, thanks. So to kind of set the stage for what we are going to talk about today, we're talking about compensation and benefits issues in the mergers and acquisition space, which I appreciate is a pretty broad topic, but we are going to try and particularly focus on some recent developments and trends, and kind of, as Diana previewed, kind of the topics we are going to be talking about are, recent M&A trends. It's been an interesting year in the M&A space, year plus. Recent times in the M&A space has kind of been different than even the earlier parts of this decade. We'll be talking about managing share reserves for equity plans, which is, become more of a popular issue. And then just be talking about deal level issues that we've been seeing, particularly as it relates to compensation and enlightening interests of various stakeholders. Then be talking about Section 280G, which is parachute payments and taxes. And then finally talking about compensation disclosure related issues. Whether you're a private or public company, there's going to be probably some sort of executive compensation disclosure. As you may kind of sense from these topics, this presentation does have a little bit more of a public company bent to it, but that doesn't mean, it's not applicable to private companies. I think a lot of these issues are applicable to both public and private companies. And if you are a private company potentially looking to be acquired, I think it's always good to know what the public companies are thinking about and what issues you need to be considering as part of the acquisition process. So with that, I will kick things over to Rama, who will be talking about recent M&A trends.
Thanks, Ajay. So, 2023, as many of you know, was a fairly down year for M&A. That was impacted by macroeconomic trends. The interest rates didn't help. There was a freeze on capital markets and alternative financing sources as well, which made financing M&A a challenge for many of our clients. It also impacted valuations, and so there was reluctance among many potential targets to engage in a transaction with the expectation that transaction value would improve if they just sort of held on. The tech sector in particular was impacted quite significantly by downward valuations. Although we did see some pretty healthy activity in terms of AI, cloud and data analytics, cybersecurity, but overall, definitely a down year for tech. In the life sciences sector, which many of us in San Diego are attuned to, we did see probably, I would say, more transactions. Many of those transactions were also guided by companies trying to manage their cash and prioritize assets, divest non-priority assets, streamline their portfolios. Also saw a number of deals using stock as currency, large and small deals, with companies using this as an opportunity to consolidate and again sort of preserve cash for a better day. We did also see a number of transactions involving public companies that had failures but had cash reserves, with other companies looking to partner with them to take advantage of the cash and also provide a potential pipeline for the public company. 2024, we're all much more optimistic. Companies do have a lot of dry powder. Looks like interest rates are starting to level out a bit. We're on life sciences and definitely seeing pharma stepping out, including with a few good-sized 2023 kickoff 2024 year-end type transactions, which has given us a lot of optimism, and also seeing the follow-on offerings, IPOs out of the gate in 2024, I think is also giving us some optimism on at least the life sciences front. And similarly, we're seeing sort of private equity maybe sort of shedding some of the hesitance it had in 2023 and engaging more. So I think all in all, we're starting to feel optimistic for 2024. And so hopefully for many of you, maybe the comp lessons in connection with M&A will start being more relevant as we see more M&A activity.
So are you predicting that 2024 is going to be a better year? Not to put you on the spot.
Yes, I am predicting 2024 is going to be better.
Let's mark this. Well, I will personally come back at the end of next year and then see where we're at.
Hold me accountable.
So, I think one of the things that Rama talked about was that there is more of a cash crunch, and you are seeing more stock for stock transactions. And in the context of that, managing share reserve has become more of a priority, right? I mean, unlike cash, equity is not an infinite supply. And so even though people are shifting more from cash transactions to stock transactions, management of stock plan and dilution is always going to be a key issue. particularly in the equity and compensating employees in M&A context. The big challenge here is that companies listed on NASDAQ or NYSE are required to get shareholder approval of their equity plans, and that would include any increases to the share pool, and how you treat the employees and their equity awards is going to be a major part of the transaction terms. In addition to kind of converting the awards, acquirers oftentimes will need to consider, the challenges with giving equity to new hires as part of the kind of the ordinary course, and then also retention of key employees, is going to be an issue too for purposes of granting new equity awards. And so, if you do not think about and plan how mechanically you are going to kind of have this equity award treatment kind of function in the M&A context, there is the potential to really kind of go through and dilute your equity plan share pool, particularly in the context, of a serial acquirer. If you're going out and you're making, multiple acquisitions as opposed to kind of a one-off deal, that really has a potential to kind of put a dent in your equity pool, and people, want to avoid going out for new plan approval because it's going to have to get shareholder approval, dilution issues. You might have to engage a proxy advisor. And then the advisory firms like ISS Glass Lewis often frown upon companies going out for equity plan increases more than every 3 to 5 years. And so we're going to kind of be talking about some things that you can be doing to preserve your share pool in the M&A context particularly. So kind of the 4 options that we are going to be talking about today. The first 2 are the kind of the main ones we typically see in the M&A context: substituting awards, where you kind of convert the target company equity awards into equity awards of the acquirer and put them on the terms of the acquirer's equity plan. Assumption of the unassumed share reserve, where you can assume the unused share pool of the target company, which can be used post-closing to potentially grant new awards to those legacy target company employees. And then kind of less so, or potential alternatives that we see in the M&A context are, using inducement grants, which public companies can do to make grants to new employees under a stock plan that's not approved by shareholders. And then you can always go back and just go forward with a new equity plan or a new equity or amendment to your equity plan for more shares. That's kind of, as I just mentioned, there's some obstacles to doing that, but it's certainly something that you can consider when thinking about how to preserve or manage your equity plan going forward. So kind of the first treatment we're going to be talking about is substitution. So I think substitution is probably what kind of most people on the street might think of as how equity award treatment works in M&A context, where it's you take the target company awards and then you convert them based on the deal price into the acquirer shares, awards to be settled under shares of the acquirer. In a substitution context, you typically do not need to get shareholder approval to just convert, replace, and adjust outstanding awards. And so, one of the reasons people like to do substitution, particularly the stock plan administrators I speak to, is, it puts everybody on the acquirer's paper, so their awards will be subject to the terms of the acquirer's equity incentive plan, and typically form of award agreements thereunder, which, is a lot easier to administer than kind of administering a bunch of different equity incentive plans and kind of having to keep track of, this plan says upon termination, this happens, this plan says upon termination, this happens. And so, that's one reason why substitution is often a form of treatment that people want to take. And then kind of one nice addition for substitution is that under NASDAQ NYSE rules, you can add a provision to your equity plan that basically says that if you are substituting awards from a target company in an M&A transaction context, you can add a specific provision in your equity plan that says those substituted awards will not dilute the existing share plan of the acquirer's equity incentive plan. And, serial acquirers often will have this provision in their equity incentive plan. You need to get approval of that provision in your plan the first time you go out to shareholders. But that is one way, before you go through the acquisition context, you'll want to review on the buy side your equity plans to see what they say with respect to substitution, and potentially that's one method for preserving share pool in connection with a substituted award. If you don't have that provision, then maybe assumption may be more appropriate, but the substitution may be kind of beneficial if you have that provision in your equity plan. And just kind of one other quirk on substitution that I wanted to flag is that in the substitution context, specifically for incentive stock options, you need to make sure that review the provisions of both the target and the acquirer's equity incentive plan. Because if the acquirer has granted incentive stock options or ISOs specifically, substitution potentially could be considered a modification to an ISO if you are giving people additional benefits under the acquirer's plan that potentially could cause them to lose incentive stock option status. And so it's just something to consider if you have a target company that's been granting ISOs before you do a substitution. And then also, when deciding whether to do a substitution or assumption, always make sure you look at the terms of the equity incentive plan for both the target and the acquirer, because the target's share plan could have some restrictions on the treatment of equity in connection with the transaction.
So Ajay, I think the one thing I wanted also, I guess, folks to think about, right? I mean, from the acquirer's perspective, there are obviously tremendous benefits from substituting, assuming equity incentives, but the unless this is sort of discussed upfront in the transaction, often the target might have a different perspective in terms of how equity incentives get treated, in particular because many equity incentive plans have acceleration provisions that are built in or give the board the authority to accelerate options, sometimes fairly broad authority. And so I always sort of recommend that this be discussed upfront, either in the term sheet stage or at the indication of interest stage, so that there isn't misalignment when you're getting into sort of deal drafting.
Yeah, no, that's a great point, because, in addition to being a business issue and a stockholder issue, it's also an employee relations issue. And, people, in the old days of 2-3 years ago, people just kind of may have been under the thought process that, if your company's being acquired, that means that you're going to be coming into a pile of money. And, that is less so the case now, given the macroeconomic environment and the fact that we're seeing more stock to stock deals. And, awards could be being either substituted or assumed instead of being cashed out. And
Ajay, for example, I mean, I would see this a lot in tech, but I now see it also in other sectors like life sciences, where an acquirer comes in and asks for a revest of equity options. So sometimes even your vested equity incentives might be up for play in connection with an M&A deal.
Yeah. Yeah. And so, as the compensation specialist, I always like to see if it's been negotiated in front hand, because, then we kind of know what we're going for. But, so it's something to be thinking about is, treatment of equity really is a material deal term and should be negotiated and thought about from the outset of the M&A process. So I think just kind of switching over to assumption is kind of our next alternative treatment of equity awards. And so, assumption is when the acquirer assumes the target's equity plan and the existing share reserve, and you keep people on the same paper that they're already on. So the existing plan document will still control, existing award agreements will still control. And similarly to substitution, there is kind of New York Stock Exchange and NASDAQ rules that allow you to do this without getting, further shareholder approval. And, this can be used particularly to kind of use that share pool to grant awards to legacy target company employees post-closing. The when you assume an equity plan, anybody that was employed by the acquirer as of the date of closing can't be granted awards under that assumed equity plan, but any new hires going forward, or anybody that was employed by the legacy target, they can be granted awards under this assumed equity plan. Just some things to think about is you can't extend the life of a plan. So if you have a plan, typically equity plans have a 10-year term often. If you have a plan that only has like 2 years term left, you can't extend that term further. And then, the plan typically needs to be a pre-existing plan. I think the NASDAQ rules specifically say that a plan adopted in contemplation of an M&A transaction cannot be assumed. But, this is kind of oftentimes what we see, particularly if people have beneficial terms in their equity plan. If you have a target equity plan that has an evergreen provision or other favorable provisions that you want to make sure continue post-closing, assumption of the target equity plan is definitely a popular alternative to take. One thing to consider I think for both substitution and assumption is that you may have to register additional shares on a Form S8 if the acquirer is a public company. And particularly for an assumption, if you're assuming the target plan, that may require drafting a new S8 prospectus. So I think those two, substitution and assumption, are kind of what we see most often. But some other ways to kind of maintain share reserve in the M&A context is using an inducement grant. So inducement grants are used in the M&A space, also used in the acqui-hire space, also kind of outside of the M&A space and the day-to-day context, particularly with respect to new exec hires. The benefit of the inducement plan is, you can grant an award in a plan that is not approved by the company's shareholders. And so, it's available to any new employees, which would include any employees that would come over in the M&A context. Any inducement awards would need to be approved by either an independent compensation committee or the majority of the independent directors of the company. And there are some, documentary requirements. Typically, you would have, an offer letter kind of spelling out the terms of the inducement award. And there are also, some supplemental issues. Again, there's an S8 and prospectus requirement. There's also, stock exchange supplemental filing requirements and potential, press release and 8K disclosure. And also kind of, we're going to be talking about Section 280G in a bit, but, in the M&A context, if you agree to an inducement award prior to closing, that amount will need to be considered a potential parachute payment for purposes of Section 280G. And so it's always kind of a push and pull how much you want to kind of iron out these awards prior to closing versus kind of agreeing to them post-closing. And then kind of the last alternative that we have here is, just a new equity plan proposal. So, I mean, you can always go out to your stockholders to get a new equity plan, which, for this purpose includes an increase to the share reserve of an existing equity plan. If you do that, that's going to require stockholder approval, which is going to be an involved process. You may have to do a proxy solicitation. You have to be smart about the number of shares you're going to be asking for, consider your hiring plan, benchmarking, go forward grant practices to make sure you kind of have the right number of shares in that proposal. If you go forward with a new equity plan proposal, I think at any time, and you have particularly an initial post-IPO equity incentive plan that has some company-friendly provisions like evergreen provisions or the ability to reprice options unilaterally without stockholder consent. If you need the approval of institutional shareholders like ISS or Glass Lewis, they do not look favorably on those provisions. So you might have to gut those provisions as part of getting an ISS approval of your new share plan reserve. So, these are all things you need to think about. We don't see this as often because of the involved process, but, if you have a deal that your stockholders really like, and you're able to bundle this as kind of an overall approval from your stockholders, maybe an M&A transaction is the right time to go out for a new equity plan proposal. So, we kind of hit on a bunch of different issues, but kind of again, just make sure to try and negotiate these things sooner rather than later, because treatment of equity really is a material deal term. Rama, do you have anything else on that topic before we move on to the next section?
I think we're gonna hit on some of those when we get to the next section, so maybe we can jump in there because one of the things that we thought would be interesting for us to talk about are sort of the various sort of interests that are at play in connection with an M&A deal in the equity incentive compensation context. And the way we think about it, you have these various stakeholders who all have their own perspectives on equity incentives. So, starting off, obviously, you have the investors who are focused on their return on investment. They're focused on, how their transaction gets treated from, a tax perspective, and how the treatment of equity incentives impacts them as potentially sort of standalone investors. And then you have, management and employees who are sometimes focused on, immediate return, which they will view as a return for potentially the risk they've taken in staying with the company, their reward for staying with the company, the reward for having seen a change of control transaction occur, a reward for staying through the closing of the deal after the deal is announced. They're also going to be focused in terms of ordinary course incentives that they are expecting to see and how that gets impacted in connection with the deal. On the board end, the boards are obviously focused on, the fiduciary duties associated with maximizing the return for stockholders. That is the basic Delaware standard, the focus on stockholder as opposed to sort of employees. But board members also have their own compensation that they are thinking about as part of a transaction. One of the things that we've seen is because of a lot of transactions are being impacted by a more aggressive regulatory environment, both in the US and outside of the US, is that deals are sometimes taking much longer to close. And both the target and the buyer are focused on, how to keep employees incentivized in that time period. From the target's perspective, obviously, they want to make sure that employees stay so that the business isn't negatively impacted, which can also impact deal certainty. But depending on whether you're a private or a public company, if you're a private company, your stockholders are taking the direct hit of any interim compensation coming out of their compensation. On the public end, often the buyer will have very strict stipulations in terms of what you can do between signing and closing. So again, sort of going back to be thoughtful about this in the beginning, get a sense of what the time period might be that might be entailed in getting your deal closed and figuring out what you want to do for your employees in the interim. On the buyer end, similarly, of course, there might be a similar incentive to keep employees engaged, but also a desire to monitor so that the target isn't going out and just bringing on new employees who now will be on your books following the closing, and you want to control those arrangements. So we found that there's a lot of discussion that goes into interim arrangements. This will also sort of bleed into the next topic that Ajay is going to cover about 280G, because in the context of where there are penalties on compensation as a result of deals, you've got to sort of manage both the impact of the existing arrangements, but also ongoing arrangements in the interim period, in addition to promised arrangements for the post-closing period, because all of that can have significant impact on key employees of the target company. The other issue, I know Ajay, we see sometimes has to do with, stock options and whether they're in or out of the money. And was wondering if you could give us some of your perspectives on that. How should people be thinking about those in the context of the deal? Let's say you have a bunch of options that are out of the money.
Yeah, so I mean, I think this goes to the topic of aligning interests really well. So, I think a lot of times historically, especially when there were fewer options that were not, out of the money or underwater, and they're having a strike price that's greater than the value of the stock in the deal. I think historically, those options would just be kind of canceled and would go away. And, typically there would be very few of those. And so it really wouldn't be a material deal issue or even an employee relations issue. But now, with the plunging valuation market, you are seeing companies that have a significant amount of their options that are underwater. And kind of there are some things that are being done to kind of maintain some value of those underwater options. I think one thing that potentially could be done, like I mentioned before, if you were assuming an equity plan, you could, and potentially that equity plan has some favorable terms that allow you to reprice unilaterally. I've seen some deals where the target company will assume the acquirer will assume the target company's equity incentive plan. And then, they will have those options that are underwater, but then they will reprice those options post-closing. So then they're effectively getting those options, that potentially have value going forward as the acquirer stock continues to rise. And then kind of another thing that we've seen too, particularly, in a life science space where the earnout may be a significant portion of the deal proceeds, is that if the option is underwater with respect to what you're getting paid up front, you may still allow those people to participate in an earnout or a CVR or other contingent payment if the total of the deal value plus the contingent payment value is greater than the strike price. And so they might get some incremental value to having underwater options if there is an earnout paid as well. So those are kind of two things that we've been seeing recently with respect to companies that have underwater options and kind of ways to incentivize people going forward and kind of let them have some value with these existing awards, even if they are underwater.
The other thing, Ajay, that I've also seen is, and sometimes you'll see this in the context of, underwater options where the holders of those options are actually going to be, terminated in connection with the deal. I will see some negotiation to extend out the exercise period so that they can sort of wait and see, if in a stock deal, if the combination results in, the either option becoming in the money or the company appearing to be more promising, so that the option holder can make a more educated guess with respect to the exercise of the options, as opposed to, having to make that decision, within a quick 90 days of the deal closing.
Yeah, no, definitely. That's something we see too. In any kind of termination, but particularly in the M&A context, the post-termination exercise period for options is something that people may be adjusting going forward. And, I know you touched on this previously, Rama, but I just really want to emphasize, the interim operating covenants, from my perspective as a comp person, are kind of one of the most important things you could be negotiating in a deal, and oftentimes they're one of the last things you're negotiating before the deal signs. Because as Rama kind of alluded to, especially with this increased regulatory environment, right? The target company always needs to be prepared. That there might be a chance that the deal's going to fall through, and so you want to balance the interest of doing what the buyer wants and making sure the buyer is getting the company that it wants to acquire, but also you need to be making sure that you are incentivizing your employees and you're giving them the ordinary course compensation that they expect in case the deal does fall through. So just as the comp person, that's really the issue that's near and dear to my heart that I'm always thinking about as kind of the deal level hot topics we're seeing, particularly in this regulatory environment with increased scrutiny.
Yeah, and one of the things we've been encouraging our clients to do, when you do your typical M&A deal, right? I mean, everyone's going to be focused, preparing the disclosure schedules for the deal, putting a lot of time and effort into that. When you're doing that, also think about the provisions that relate to, the prohibitions on comp-related matters, hiring matters in the interim period. Like, don't wait for it until you're 2 weeks down. You spend 2 weeks with your head down working on the disclosure schedule. Make some time to think about that topic concurrently so that you can perhaps with more lead time present your asks to the acquirer and have a more meaningful discussion than having that discussion at the very end, which often will then result in a less favorable end result potentially from a comp perspective.
Yeah, no, and I think oftentimes, right, you'll see the acquirer push back on certain things, and if you're the target, right, I think it's great to be prepared with kind of almost like a presentation, be like, this is what we've done, this is what we're expecting to do, this is what we need to do just to maintain the status quo of our company, because oftentimes the acquirer will kind of look to that historical practice to set the terms of the interim operating period in terms of what they will allow going forward. All right, so I think the next topic that we are going to discuss is section 280G. It's a section of the US tax code related to parachute payments. I know whenever I start talking about taxes, it causes people to gloss over a bit. So we'll try and keep this high level. And this is why we didn't come out of the gate with this. But I probably could talk over an hour on just section 280G issues in both the public and private company context. This is one area where it is different for public and private companies, and we'll kind of go into that in a little bit later. But so just at a high level, section 280G of the tax code applies to excess parachute payments paid to a disqualified individual that are contingent on a change in ownership control of a corporation. So we have kind of I should mention the appendix to this slide deck, which I think should be made available to you. There are a bunch of additional slides on 280G and inducement awards and a bunch of the topics we're talking about. So we could kind of keep the deck at a high level. But just, excess parachute payments are payments made in connection with a corporate transaction. A disqualified individual is typically going to be an officer, a 1% shareholder, or the top 1% of highly compensated individuals in a corporation. And it is, a corporation, if you are a private company that is a partnership or an S Corp or an LLC that's taxed as a partnership, you are potentially exempt from these 280G requirements. But if there is a section 280G problem, then that means the disqualified individual is subject to a 20% excise tax on the excess parachute payments, and the paying corporation loses the corporate compensation tax deduction for those payments. So if it's a payment made by the target company pre-closing, they may not be able to take that tax deduction. If it's a payment made by the acquirer post-closing, they would not be able to take that tax deduction. So kind of both sides have an alignment of interest here to make sure that the 280G issues get resolved and kind of addressed properly. To determine if somebody has a 280G problem, kind of the first thing we do whenever we're kicking off a deal and starting 280G work stream is identify who the disqualified individuals are. And then you need to kind of identify what their 5 years of compensation history are. It's the 5 years preceding the closing of the deal. So if the deal closes in 2024, it's, I guess, up to 23, 22, 21, 2019. So, you take that 5-year average, and if the payments they receive in connection with the change of control exceeds 3 times that amount, then we say somebody has a 280G problem. And then if they have a 280G problem, that 20% excise tax and loss of deduction is on anything in excess of 1 times the base amount. So it's your 1 times your 5-year average over one times your compensation average over the 5-year period is potentially subject to a 20% excise tax. So, I mean, that can be a pretty significant amount, particularly with respect to larger deals. And this is one area where private and public companies, there is a big difference. For private companies, you can do a cleansing stockholder vote that kind of gets rid of this 280G problem. And we'll go through kind of the mechanics of that in a little bit. But for public companies, you do not have this cleansing vote ability. And so, for public company sales in particular, it really is important to get in front of this 280G problem because there's some mitigation issues, and it's going to be a business negotiation issue as part of the transaction that you really need to be thinking about from the outset.
Just a couple of things that I'll note here. So one, often where we'll see folks getting tripped up on this, one common scenario is you've had an executive who's just started, let's say in the last year, they've received their standard package. Not much of that has vested because they've just been around for a year. Along comes an acquisition proposal. Individuals in that scenario can be very significantly impacted by the 280G, and as a result, it can become a pretty significant part of transaction discussions. As Ajay said, this is also obviously one of these things that you're going to also have to think about early. And so often, right, a big part of this is actually like the calculation of the 280G hit. So again, back to sort of a theme that we've had thus far, think about that early and start those calculations going early, because again, this can have very real, dollar impact.
Yeah, no, and then that's a great point about new hires, and 280G math is not real math. Potential payments in connection with a change of control is a pretty wide swath of payments. We often get on calls with clients or executives and they think that 280G is not going to be an issue for them because they're like, oh, we're not really getting anything. But as Rama mentioned, there are a lot of things that can be swept in. Payments made within 12 months prior to the change of control are often presumed to be in connection with the change of control. So you can, as she mentioned, the new hires in particular can really get swept up there. And right, there's things like post-closing severance and a bunch of other things where, it is really important to get out in front of this as soon as possible, to identify pre-deal, identify your disqualified individuals, figure out what their base amount is, identify what the universe of parachute payments is, particularly, on the company side, right? You are the provider of facts. And so that is, really important to start thinking about and organizing all of that information. Because, once you get the process started, there's going to be, typically you hire an accounting firm, especially for public company deals, that are going to kind of perform the calculations for the 280G analysis and determine whether or not there are any potential 280G issues. And so, it is really just important that, particularly in the public company context, right, the time to think about 280G is not on the eve of transaction. It should be on your radar far in advance of transactions. I mean, I've been on 280G calls before I even knew a deal was happening, because the company knew and they looped you in then. And so, you want to start working the second you know that there is a deal. And, because in the public company sense, there is no 280G cleansing vote available that there is for private companies, part of the reason you want to get in front of this is potential mitigation on the scope of the 280G issues. So, there's kind of two sides of the coin in terms of mitigating 280G negative outcomes. The first side is increasing the 280G safe harbor, that 5-year average for the years prior to the change of control. And then the second one is decreasing parachute payments. So, like this might be a scenario where you have an exec who's kind of being magnanimous and they have a $1 compensation that they agree because they don't need any, they don't think they need a base salary, but that has potential 280G implications if, you're determining the 280G base amount based on historical compensation and they haven't been taking a reasonable salary. And so some mitigation things that we frequently see, one is, you can get things out of being potential parachute payments if there is an agreement that it's reasonable compensation. That's both reasonable compensation for personal services rendered before the change of control, which would include potentially bonuses and other performance-based compensation. Also for services rendered to the acquirer after the change of control, there's a variety of things that could be considered reasonable compensation, including any increases to comp. If it's kind of typical to what the acquirer pays similarly situated people, but the IRS requires that any amount that you determine to be reasonable compensation must be established by clear and convincing evidence. And so, oftentimes you will have an acquirer that is maybe a little bit more risk averse in this sense to determining things are reasonable compensation, because the standard for establishing reasonable compensation was a little bit higher than kind of typical. And then some other strategies are pulling compensation into an earlier tax year. So for example, I've seen deals where you think you're going to close, for example, say we had a deal that was being negotiated late in December and it's going to close in, February, March, April, and you would have ordinary course payment or bonus payment or other payment that would maybe be payable early in the year, like January or February. If you pull that into December of the previous year, because you're determining the 280G base amount for the 5 years prior to the change of control, that actually, accelerating that payment by a couple of months is a way to increase the 280G base amount and potentially mitigate any exposure around 280G. And then, you always want to kind of look at employment agreements. And oftentimes we'll see, particularly for executives here in Silicon Valley, they may have 280G provisions in their employment agreements. A net best provision is something we oftentimes see, and that basically means that the executive will agree. You kind of see what the total amount of payments they will receive is. You calculate what the tax impact is, including that 20% excise tax, and they kind of take what they're better off, either the full amount with the excise tax, or they agree to cut back a portion of their potential parachute payments so that they, do not have a 280G problem. And so, these are all potential 280G mitigation strategies, particularly in the public company context. 280G gross ups are a thing that still exists, where you see the acquirer will agree to pay the excise tax amounts for people that are coming over post-closing so that they're kind of made whole and they do not suffer these adverse tax consequences. But, a buyer is not going to agree to pay a gross up until you've kind of taken all actions around mitigation. And that's going to be, that is going to be a negotiated deal term too, is they're going to, want a cap on the gross up amounts. They're going to want to know what mitigation efforts that you've taken as part of the 280G process, because, they're not just going to want to give you a blank check for your target company executives to come forward and kind of get the full proceeds of the deal without, the target company taking any mitigation actions.
And I'll add one caveat to the earlier comment about, think about all of these things early, reach out, have conversations. When it comes to the gross up point, there are, as you can appreciate, conflict of interest issues. with respect to the management or board putting forward arrangements that are clearly for the benefit of executives. So we will, generally recommend that there be no discussions with respect to a gross up early on in the discussion. Certainly the price for the transaction needs to be established before any gross up discussions are initiated, because if those are initiated early, they can taint the process and present sort of significant concerns from a deal litigation and fiduciary duty perspective. So just something to bear in mind if you're going to find yourself in a world where you're going to be making an ask for a 280G gross up payment.
No, that's a great point, and a good perspective to have from the M&A deal lawyer in the room, for sure. So I think just going to spend a couple of minutes talking about 280G in private companies. So, as I mentioned, if the target company is a private company, you can avoid this 280G problem by getting approval from more than 75% of the shareholders that are entitled to vote, shareholders of the target company. And so, when you're determining this 75% threshold, anybody that's subject to the vote because they have excess parachute payments are removed, any immediate family members or entities they control are removed from both the numerator and the denominator for purposes of getting to that 75% threshold. Kind of the process is that if you have a disqualified individual that has a 280G problem, they will sign a waiver that effectively says that if the private company does not get the shareholder vote, then they will agree to waive a portion of their payments in connection with the transaction that are in excess of 3 times their base amount. And so, I've been doing this for quite some time now, and I have yet to see a 280G vote fail. But, it is something for a private company, but it is something, the people are a little bit more concerned about now, especially in the current economy where you may have like institutional investors that hold a large number of shares in the company. There might be more sensitivity if their investor return is not that great. They do not want to be seeing executives, getting a huge windfall from the transaction. So it kind of depends on the facts and circumstances. Always need to consider your shareholder base, reach out to larger shareholders as part of the engagement process, and let them know this is coming. But one really sensitive issue for this private company 280G vote is adequate disclosure needs to go to all shareholders entitled to vote. So even though you only need 75% to get the cleansing vote, a disclosure document that's going to have, the historical compensation for your disqualified individuals. It's going to talk about what their potential parachute payments are. Potentially could be discussing, go forward arrangements with the acquirer. All of that information needs to be sent to all of your shareholders, which could include employees that have exercised options. And so oftentimes, we will have this conversation with founders or private company executives where they really kind of freak out that this is going to be happening. But, the alternative is you take this 20% excise tax hit. And so, as long as you ultimately there's ways to, must explain this to your executive team to make sure that they know that this is coming and make sure they're prepared for this, because it is ultimately, right, people would rather have their compensation disclosed than get a 20% excise tax hit. And, oftentimes people are concerned about this disclosure, but most of the time people don't even read what they're sent. And so just kind of make sure that your executive team is aware that this is a potential issue, even in the private company sense. I mean, in particular, we're seeing this as a point of sensitivity, I think, as we see more cross-border deals. Section 280G only applies the US IRS can only hit you with an excise tax if you're a US taxpayer. And so if you are not a US taxpayer, then you are outside the reach of the IRS and are potentially not subject to this excise tax. But there are potential complications if somebody becomes a US taxpayer post-closing. There could be two QADG issues, like if the acquirer wants them to move to the US post-closing. And, oftentimes, like if you are a private company and you're being purchased by a large public company that has all the leverage, oftentimes they're just going to say, we're not going to take any risk. We want to put everybody in here. We want to cast as broad net as possible. We don't care if they're non-US taxpayers. We want to include all of this information. And, I've been on many conversations where kind of explaining to non-US executives why you're potentially waiving a portion of your deal proceeds for a tax you aren't even subject to. But kind of given the economic leverage of a serial acquirer, if you were a private company, that might be something you need to consider. And, just something that you need to make sure your executives are aware of as part of the M&A process, because, it is a highly sensitive subject when you're talking about compensation and disclosure. So I know it looks like we only have a few minutes left, but I will just go quickly on compensation disclosure issues. So, I think kind of the key is whether you're a private company or a public company, right? There's probably going to be some sort of executive compensation disclosure. If you're a private company, there's going to be this 280G cleansing process that we just said. If you're a public company, there's potential disclosures in connection with a merger proxy. And, for larger public companies, you may have to have a say on golden parachute vote, which is, an advisory vote on executive compensation received by named executive officers in connection with the transaction. And so, as part of that, you're going to have both a tabular and narrative disclosure that's going to kind of spell out the compensation that people are getting in connection with the deal. So, it's just, these things are going to be disclosed. There's potential 8K disclosure requirements, like when you announce the deal, often the treatment of equity is going to be described in the deal. Any go-forward arrangements with executives might need to be disclosed. And then if you take certain actions in anticipation of the change control, and you're a public company, you may need to disclose those as well, like if you implement a change control severance plan or other plans. So, just always remember that there's going to be compensation disclosure, both from a corporate perspective and also just from a executive relations perspective. Just be aware that these issues are going to be there. So I appreciate that we've kind of thrown a lot of topics at you in a short period of time. And these are issues that Rama and I think about every day, and not everybody might be thinking about. So just kind of want to wrap things up with maybe a key takeaway. Rama, do you want to give your key takeaway real quick, and I will give mine after?
Yeah, sure. So I'm gonna stick with, think only about comp matters and how they fit into the larger deal. And think about your various constituents and, what their perspectives are with respect to the deal, and think about how you can reach alignment between among all the constituents when it comes to comp related matters.
Great. Yeah, and I think I agree with all of that. Comp issues are deal issues. And, I think my takeaway is, the M&A process, especially on the sell side, can be a daunting process. But, as outside advisor, it's always easiest for me if the teams are coordinated. So just, which I realize can be tough when not everybody might be under the tent from the outset, but the more the company can do to just kind of, this is going to touch on tax, finance, legal, HR, stock plan admin. So, as much as you could do to make sure your internal teams are talking, it's going to make the acquisition process and your outside advisors more efficient as well.
And then I'll add to that, Ajay. I mean, obviously these are very sort of technical areas, and there are specialists who can help you. So, folks like Ajay, but also, right, consultants who will do your 280G calculations for you, and others who can be brought in, accountants who can be, brought in early. So just sort of remember that, and give yourself sort of enough time and space in your checklist to make that happen. And I think ultimately everyone will be happy that you spent the effort.
Great. Well,
Great, thank
so
you,
much.
Ajay and Rama. And if you have a few minutes, if there are any questions, please let us know. Participants are still here. The materials will be uploaded onto the ACC San Diego website, so please look for those there if they're not already there. Any questions from the audience? Great. Ajay and Rama, I assume your contact information is in the materials?
Yeah, I think it's on the, it's in the slide deck, so. you can find
Perfect.
this.
Great. So folks can reach out to you directly if they do have questions or think of a question afterwards. Thank you,
Great.
everyone.
Yeah, thank you for having us.
Thank you so much.
Thank you. Cheers.
All right. Bye.